Well, Asian markets, they are trading mixed ahead of the crucial Chinese economic data. The Kospi, for starters, that's the one that's trading in the red. It's down close to around 0.2%. But the Straits, that's trading in the green. So it was holding in the green, though it's come off the high point of the day. Currently trading more or less flattish as we speak. So let's get the Straits as well up for you. And even the Taiwanese index, more or less a flattish start, just to kickstart trade. To sum it up, really, the Asian markets, they're more or less open on a mixed note or thereabouts. The SGX Nifty, though, for starters, is indicating a bump up of around 20 to around 25 points. Remember, in today's trading session, you have the Japanese index. That is shut on account of a public holiday. So more or less flattish to start off trade in the Asian markets. But the SGX Nifty is indicating 20, 25 points. Let's see whether or not we get that.
Let's talk about the U.S. markets then. On the Wall Street, U.S. market ended mostly lower on the ongoing U.S. government shutdown and worries about economic slowdown in China. The Dow and S&P ended with minor losses. The Nasdaq, that dipped 0.2%, and this was the first decline for the major indices in 6 sessions. CNBC's Eric Shemi gets us a wrap of all the action on Wall Street.
U.S. stocks mostly flat on the day, though up more than 2% on the week. The Dow down 5 points, the S&P fractionally lower, and the Nasdaq off 14. U.S. consumer prices falling for the first time in 9 months in December, thanks to a big drop in the cost of gasoline. Underlying inflation pressures remained firm, though, as rental housing and healthcare costs climbed for the month. Meanwhile, Apple is reportedly planning to unveil 3 new iPhone models later this year. That's according to the Wall Street Journal. The tech giant's new phones will reportedly include new camera features and higher quality displays. The report comes a week after Apple slashed quarterly guidance due largely to slower sales of its XR model in China. And if you're looking for a dollar figure for the cost of the government shutdown, S&P is working on it. According to the ratings agency, the U.S. economy will have lost $3.6 billion as of because of the shutdown. In 2 more weeks, S&P says that figure will jump to $6 billion. That's more than the $5.7 billion figure in funding for the wall that Democrats and Republicans are fighting over. That's the action from the U.S. market. Back to you in Mumbai.
Well, on that note, here is some opinion from Ruchir Sharma of Morgan Stanley, who expects emerging markets to do well going forward.
Emerging markets, which have been so beaten down over the last decade or so, could be the ones where the comeback is, formed out there. So that's the term that I come up with, the anti-bubbles. That's the piece that I wrote about for the Times, which is the fact that the anti-bubbles are the exact mirror image of the bubbles. These are the sort of markets and economies which have been working out the excesses, and that's what America did. We could be at an inflection point. That the American economic expansion is quite long in the tooth, it's quite mature, the dollar is very expensive, and the fact that some of the world's other stock markets are looking relatively cheap, and also the growth prospects in some of those economies is not that bad. Like we saw a big sort of workout of the excesses which were built up after last decade's boom. So I think that we could be setting up for a big role reversal after this extraordinary decade that we have seen for America over the last few years.
Well, interesting view coming in from Ruchir Sharma on the U.S. markets as well as emerging markets for 2019. Moving on then, the European markets, they ended low on Friday with Brexit developments and a more dovish outlook from the United States Fed Reserve. Those are the key points that remained in focus. In terms of data, the GDP figures show that the UK economy slowed down in 3 months to November, hit its weakest pace in nearly around 6 months out. So all the 3 frontliners ending with cuts of around 0.3 to around 0.5% out.
Let's move on to the currency space then. The dollar index, which measures the greenback against a basket of major currencies, is mostly flat amid cautious signals from the Federal Reserve about further rate hikes.
Last year, we started off with a hawkish surprise out of the U.S. that U.S. growth ended up being even faster than expected because of the double fiscal stimulus. This year, we're in the longest ever government shutdown, and we're not getting more stimulus coming through. And instead, it's more a case of how much more dovish can the Fed end up being versus last year, how much more hawkish. That translated into what we're seeing in the dollar. At least all it needs to mean is flat and then medium-term lower on the dollar. And we believe the dollar has put in a medium-term peak already. That should take some of the pressure off emerging markets that don't need to have as tight policy as they otherwise would have done.
Well, turning our attention to the all-important crude oil prices, they came off the highs as global growth slowdown concerns. That's what weighed on sentiment, and that's why a bit of a downtick is what you've seen over the weekend.
We're looking for a very sizable reduction in supply coming from OPEC+. Of course, Iran sanctions will presumably be tightened into the second half of the year. And remember, demand is not as bad as we feared it was 3 months ago or even 2 months ago when people started talking about recession. The word recession seems to be fading. And eventually, not just the Saudi put on oil markets on the supply side is kicked in, but also I think the Powell put is starting to kick in as well with a friendlier Fed commentary in recent days as well. So that's the combination of those three factors. I think inventories are going to eventually rotate away from the big inventory build we saw in the fourth quarter into inventory declines, and that's going to push up prices as well. WTI, however, may struggle to follow Brent into the higher price band. So even if Brent goes up to 70, we think WTI maybe mid to high 50s should be the right range for WTI for this year. And then, heading into 2020, we're a little bit more concerned because by then we're going to have a lot of new pipelines coming out of the Permian Basin and maybe more supply than the market needs.
Meanwhile, OPEC Secretary General Mohammed Barkindo is largely optimistic over prospects of achieving a balanced oil market in 2019, but is concerned about lingering trade disputes.
We need to continue to collaborate with the companies in terms of knowledge sharing, data sharing, benefiting from their strategies. They have done extremely well in combining technology with cost-cutting strategies and yet maintaining high level of productivity and efficiency in the industry that we believe will be beneficial to the rest of the global industry, especially the long-term, long-cycle projects onshore and offshore.
Okay, time to slip into a snappy break. You come back, we'll tell you all the cues and news that are stacked up for us when we open up for trade in the next couple of hours. Don't go anywhere.